You know what? I'm going to say what's on a lot of people's mind. I fear heights.
I get that. We have seen a lot of cash flow into the US stock market in the first half of 2021.
Yep, over $500 billion into equity funds globally, according to Goldman.
That's a record, and over half of that flown into US market.
People are bullish.
But let's not forget the PPI data we got earlier this week, up 7.3% in June year over year.
Bro, inflation.
Yep, this is new year over year record.
But guess what? The old man came out Wednesday and said,
Let me guess, the inflation is only temporary?
close. He said that there is still a long way to go before the market is healed. Basically, the inflation now won't be an issue.
But this time he added that he will alter policy only if inflation persistently on the higher end.
Yeah, I remember that. On the crude oil side this past Wednesday,
Oil prices dropped more than 2% on Wednesday and dragged the entire market down with it.
yep, the oil prices fell on the news after Reuters reported Saudi Arabia and the UAE finally agreed on a deal to supply more oil over OPEC Plus policy after a 2-week standoff.
Earlier this month, most of the OPEC Plus members had agreed on increased oil production output by 400,000 barrels per day, and UAE refused to sign the deal.
I heard a lot of different numbers too. I also heard they want to increase the output number from 3.2 million to 3.8 million barrels per day. I think 3.65 million barrels per day is what most members of OPEC Plus agreed on for now.
I mean, I'm not surprised to see a clash in this. Each of the OPEC Plus members all have their own country's self-interest.
Exactly. The UAE thinks now is a great time to take advantage of the oil demands and pump the oil out of the ground faster before the global energy transition away from fossil fuel.
Well, this is a simple math. Higher oil production outputs will drive up the supply, which will cause the oil prices to fall.
And US on the other hand came out and say, no, 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 we don't need that much oil.
So many analysts were discussing that oil prices might hit $100 a barrel this year. Is this still realistic?
Let's look at it this way. If the global economy post-COVID resurgence is in place, I think it is possible for $100. I would keep your eyes on China oil import number. I mean, their crude oil imports fell 3% from January to June versus a year earlier. Does this mean their economy is slowing down?
That's a great indication. We should keep our eyes on their import number. And do you see that BlackRock's boss, Larry Finn, said that he doesn't see inflation as a transitory?
That's surprising, since BlackRock has always been the US government's best buddy when it comes to finance. I am shocked that he's disagreeing with Powell openly.
He said the 1970s inflation that we talked about in one of our video a while back is not likely, but we are going to see above 2% inflation and probably closer to 3.5 to 4%.
And also, he thinks the Fed will have to change policy.
Anyone who invests seriously know who Larry Finn's impact on the market. And even if they don't know who Larry Finn is, they have to know who BlackRock is.
Yup, they are the world's largest asset manager with over $9 trillion of assets under management.
That's insane. If BlackRock sneezed, that could explain why the market dipped 2%.
So that's why when Larry Fink said this inflation is not transitory, the market takes it seriously.
Not just Larry Finn, though. Trump's Secretary Mnuchin also said on Wednesday that the Feds should start tapering.
Those two definitely have a point. From the rise in price of raw materials, wages, oil, the corporate margin has been decreasing. And eventually, companies will pass the cost on to us, the consumers.
Right, and that's why Powell smoothly gave himself a way out by saying that the Fed had begun discussing a reduction in assets purchases and will continue to discuss in the upcoming meetings.
So if we know that the Fed is talking about it now, who else would know?
Most definitely the institutions.
Most definitely Goldman. Ever since the start of 2021, they've been dropping stocks like it's hot.
Wait, how come I didn't hear about this?
Oh, you think Goldman is going to let you know when they dump their positions? Please.
Wow. Let's take a quick look at their earnings this week then.
Let's get right to the point. Check out their significant progress in asset sales.
I am a little amazed. So they bought $1.5 billion worth of assets and sold $5.5 billion in the meanwhile.
Yup, so far they sold over 20% of their total assets this year.
Also, during the earning call, someone asked the CEO about the $5 billion asset sales. And since Goldman's stock is at an all-time high, shouldn't Goldman be focusing more on revenue growth rather than selling stocks?
And Goldman said, I quote, "It's a very constructive environment for us to do so, and we will continue to do that."
Let's translate that in a few sentences. The constructive environment, that's for selling stocks?
Needs two things. First is enough liquidity on the market, meaning there are enough buyers.
Exactly. For seller like Goldman, if there aren't enough buyer when they sell, it is very likely for the stock to fall like a knife. They can't make as much money if the stock price is plunging when they sell.
And second is having enough time. If seller like Goldman, if they don't want to create fear in the market that they're selling, they can't just boom and sell everything in one day.
Exactly. That would drag the stock prices down as well. So they sell in portions. That's smart. Make sure that the retail trader are catching the shares so the stock prices doesn't reflect much turbulence.
And that's why you didn't hear about it.
These sneaky son of a bitches. And like we mentioned in the opening, there is a record amount of money flowing in the stock market. So the environment definitely supported Goldman's to dump.
Exactly. And looking at some of the numbers from Goldman Earning, it might be good for us to be extra careful on adding or opening more positions.
Yup. Even though EPS of 15.02 beat an estimate of $10.24, and the revenue of 15.39 billion beat 12.17 billions, looking at some of the subcategories is not looking very promising.
Trading revenue is 4.9 billion, which misses estimate of 5 billion, and fixed income comes in at 2.32 billion, which is down 45% year over year and missed estimate of 2.49 billion. Equity sales and trading revenue is 2.5 billion, which is down 12% year over year, but a beat estimate of 2.53.
So basically, the overall EPS and revenue beats are because they don't have to provision huge chunk of money for pandemic environment.
Yep. So multiple segment growth are slowing down. And with this earnings coupled with the amount of asset sales, we should be wondering, is it time to wait for a significant correction?
I think so. Well, let's take a look at next week's market for some key levels.
All major indices closed the week red, and the worst performer, small cap, dropped almost 5%.
Yep, most red is discussed stock like AMC drop about 25%, Virgin Galactic drop about 38%, and Wish down about 17% for the week.
I think this is just the beginning. Looking at the S&P 500 and the Nasdaq daily chart, both are having consecutive red days towards the end of the week.
3 black crows. That's a textbook bearish patterns. Likely this is an indication that more downsides into next week.
We have 14,570 as our first support for the Nasdaq, and that's also right above the 20-day moving average.
The S&P daily chart is not looking very pretty either. One big engulfing red candle, and it looks like it's going to test our first support at 4,300.
Looking at the weekly chart for these two, we have a doji for last week's close and followed by a red engulfing candle this week. Let's give it another week or two to confirm if this is a topping reversal.
I agree, but based on how the market behaved in the recent year, we might see a couple red days and sometime a half red day, and then the market instantly V's back up.
Yeah, I'm very used to that. We're still holding our hedges to protect our positions, so we rather play it safe here.
Well, last but not least, Dow Jones broke out recently and dipped right back down this week. This is a false breakout, so we might expect to see more downside into next week.
So here's my market prediction. First, the market had already begun pulling back, and this could last until October. My guess is roughly 15 to 20% pullback.
I can see that happening. Or maybe, let me guess, your second prediction will be that we are expecting a small pullback this month and bounce in August, but the market's correction should continue in September and October this year, which is likely to be about 15 to 20% from the recent all-time high.
Yeah, all I'm hearing is trade with caution and protect your positions.
Also, did you hear that China is injecting $150 billion into the economy?
Yep, that sounds a bit concerning to me, don't you think?
Well, China is probably one of the least impacted countries by COVID-19 and now needed an injection boost to their economy.
Recent data have shown that China's economy is projected to grow 8.5% this year before slowing down to 5.4 in 2022.
As we mentioned earlier, their crude oil imports also have dropped to the lowest monthly level since the start of the year.
And what does this mean to you?
We definitely will see a short-term rally from the monetary easing.
Yeah, tell me something I don't know already.
This is very clear that the Chinese government is concerning the growth of the economy into the rest of the year.
The People's Bank of China said Friday it would cut the reserve requirement ratio by 50 basis points for all banks and believe this can improve stock market liquidity and generate more cash flow in the economy.
But the additional liquidity will not drive a sustained market rally. By injecting $150 billion into the economy, China is pretty much acknowledged the risk to their economy growth into Q2 and Q3 this year.
That's true. China might have already peaked from the post-COVID recovery.
I agree. In the short term, with the $150 billion injections, we might be able to see some good buying opportunity in the tech space. Aside from my favorite two Chinese tech giants, Baidu and Baba, which have a strong earning expectations as usual, I might pay some more attention to the Chinese EVs, batteries, and clean energy sectors.